to my YouTube channel. In this video, I'm going to take you through how I'm able to take my trades using my simple strategy. My strategy only has 4 steps. First of all, it only has 6 steps, but majorly the 4 are more important. So I'm going to take you through how I do my analysis, and I'll start with the theory part, then I'll take you to the practical part of it. So before I take a trade, I first concentrate on market structure. Market structure simply refers to the direction of the market. I have to first know where is the market in an uptrend or in a downtrend. So for example, in this illustration that I have, these are different types of market structures. So this is a bullish market structure, commonly known as an uptrend. This is a bearish market structure that can also be called a downtrend. And this one here is a sideways market. It can also be called a consolidation. This is a bearish market structure and this is a bullish. So I'm going to explain to you why a market is called a bullish and why it is called a bearish, and what to do when any of these is seen on the chart. So first of all, a bullish market structure breaks structures to the upside. For example, here it broke structure to break the previous higher high, then it pulled back, broke another structure, it had to pull back and break another structure. So in this illustration, you see that the market is in a clear uptrend, which is called a bullish market structure. And then we go to the bearish market structure. Bearish market structure is a downtrend where market breaks structures to the downside. So to take a good trade in Forex, you have to trend with a trend. So in this market, in the bearish market structure, we look for sells. As you can see here, it is breaking structure to the downside. So here we look for sell position. Then in a sideways market structure, this one, which can also be called a consolidation, we don't take trades. This is the time for you to sit and watch the market. In case you take a trade here, it might not be a good one. So I usually wait for market to either break to the upside or break to the downside for me to take sales. So that is point number 1, market structure. Point number 2 is a break of structure, usually called a BOS, a break of structure. So a break of structure is a break of a previous high or a previous low, depending on the type of market. So if it is an uptrend, this is a break of structure in an uptrend where market breaks the previous high. There we consider it as an uptrend. Then in a downtrend, this is where market breaks structure to the downside. For example, when we have market going like this, every time it breaks a low, that is a break of structure. So in my strategy, I consider breaks of structure as my point number 2 before taking a trade, as my step number 2. Step number 3 is a origin of the break of structure. The origin of the break of structure. So as you can see, before market breaks structure, it first pulls back to some point before breaking another structure. So here is an example of an origin. An origin can be called an order block, or it can be called a demand zone, or it can be called a supply zone, depending on where it is. For example, here, this is an order block where I had to wait for market and place my order here. I usually wait for market to mitigate the extreme origin, even if there are other origins, like let's say there is an order block here or a supply zone here, That one is usually used as liquidity, which is my next point, I think. Yes. So to explain the origin best, I may say it is the last consolidation before market making a break of structure. The last candle in smart money concepts, it can be the last candle before the fair value gap. So fair value gap is the gap between the third and the first candle in a chart. I'm going to take you through the practical part of it on the charts. So this is my outline. The next point is liquidity. So liquidity is the lows or the bottoms or the trend lines before my origin. For example, market might kind of pull back here and do this, stops here, goes high, comes back, goes high. All this here is liquidity. I take this to be liquidity, and I usually mark it using dollar signs to show that it is money in the market. Yeah, this is liquidity there. So to take a trade, I have to make sure that my origin here has liquidity above it or has liquidity below it. Assuming it is a sell and my origin is here, I have to make sure that there is some liquidity around here before I take my trade. I have to make sure there is liquidity before the origin. So my next point is imbalance. But before imbalance, let me first explain liquidity. Liquidity is when you see, let me do another illustration here to make you understand the proper concept of liquidity. You see market here broke structure, it came back. So this is usually for the early buyers, to trigger the early buyers or the early sellers. Market comes back, doesn't mitigate my origin. Assuming my origin is here, I usually place a pending order on my origin. As you can see here, it hadn't tapped my origin, so I patiently wait for market to come back and tap into my origin. Then I enter my position because I will have placed a pending order here. For example, here, since it's a buy, I will have placed a buy position. Sorry, let me move this to here, to the center, to there. So since it's a buy position, I will have placed my pending order here. So when market comes, it immediately triggers my order straight to take profit. And today I'm going to even show you my trade that I took today using this same strategy, so that you may appreciate the strategy. So this is the setup I normally use. As you can see, we have gone through market structure, break of structure, origin of the break of structure, liquidity, and imbalance. So let's go to imbalance. Imbalance is the space between the first and the third candle before a break of structure. So before I enter a trade, I have to make sure there is imbalance. For example, here, there must be an imbalance here before my order broke, or before my demand zone or supply zone, for me to consider it to be a high quality setup, an A+ setup. There must be a fair value gap there. So the fair value gap is where the buyers were either too many or the sellers were very many than the sellers or than the buyer here. So a fair value gap is this. Let me show you on the live chat now. A fair value gap is this space here. For example, here, this is a fair value gap. This space, as you can see, market reacted to this fair value gap on this trade. So I don't trade fair value gap, so I'm going to take you a trade which I took using the exact concepts I've taken you through. So first of all, market structure. My trade is around here. I'm going to use this chart to take you through market structure and the other concepts. So because as you can see, market broke structure to the upside. Then I had to go to the origin of that break of structure, which was this candle here. This is my order block, call it a demand zone. So I waited for price to come, and before that, as you can see, there is a fair value gap. The space between the third candle, this is my fair value gap. The gap between the first candle after the consolidation and the third candle after the consolidation. Yeah, let me zoom it so that you can see it properly. This is a fair value gap here. That space between the first and the third candle after the consolidation. So I had my order placed at the origin. Then liquidity, my liquidity was here. As you can see, price came and took out those people who were trying to buy from here. It triggered them using that candle. Let me use this drawing tool to explain to you. Price moved up, reacted, it came back. Oh, this is liquidity. It had to go back. It came here. These are the double bottoms I was telling you about. It came back before tapping into our order block. Then it triggered our order. Then we went straight to take profit. I usually take profit at the next